So, guys, let's know which one is better for your future, the stocks or real estate, the ultimate wealth building matchmaker.
If you spend any time on the modern financial internet, you will run into two completely opposite tribes. One side claims index funds are the only logical way to build wealth, while the other swears by rental properties. Looking at the data, the S&P 500 has reliably returned about 10% a year over the long term. You buy in, let the market work, and wait. Real estate functions differently. While a house might only appreciate 3 to 4% a year, adding in monthly rent and a bank loan can push your actual cash-on-cash return toward 20%. We will analyze these literal trade-offs to build a framework that maps each asset class to your current career stage and net worth. Accessing the stock market has almost no friction. Thanks to fractional shares, you can open an account and invest your very first dollar today. That single dollar instantly spreads across hundreds of global companies. If you buy an S&P 500 ETF, your risk is immediately distributed across tech, healthcare, and retail. Real estate has a massive capital wall at the entrance. To get a loan with reasonable terms, you generally need a 20% down payment, plus several $1,000s more for closing costs. This high cost of entry creates concentration risk. You're taking a huge percentage of your wealth and tying it to one specific neighborhood in one specific city, relying on a single local economy to stay healthy. While you spend 5 or 10 years piling up enough cash to afford that first down payment, you are missing out on years of compounding growth in the liquid markets. Stocks offer immediate accessibility and diversification. Real estate functions as an exclusive club that rewards you only after you clear that high capital hurdle. Once you clear that hurdle, you gain access to the primary mechanical advantage of real estate, using bank debt to control a large asset. This diagram shows the math. If you put 20% down on a $500,000 house and the property value increases by just 5%, your actual cash investment results in a 25% return. On the other hand, a standard stock portfolio lacks this multiplier. While you can borrow money to buy stocks on margin, the structural risks are high enough that most investors avoid it entirely. But debt also amplifies your losses. If local property values take a dip, the total house value only shrinks slightly, but that drop can wipe out half of your actual equity. If the market turns and you cannot maintain the payments, the bank can step in, taking the asset entirely. This leverage allows for rapid wealth accumulation, but it requires precise market timing and cash reserves to keep it from becoming a liability. These assets also demand different amounts of your time. Index fund investing is truly passive. Once your contributions are set, it requires no physical labor from you. The trade-off for that freedom is a loss of control. You cannot dictate how Apple runs its business. You are a passenger, relying on corporate management and the global economy. Real estate is often marketed as passive income, but collecting rent is actually the revenue of a small business. This business involves literal friction. You have to screen tenants, manage emergency repairs, and pay property taxes. These costs erode your gross rental yield. Even hiring a property manager still requires your oversight, and their fees will take a significant 8 to 12% cut out of your profit. Stocks pay you to do nothing, but offer zero control. Real estate gives you the power to renovate and raise rents, but it forces you to price in your own labor. Stocks are extremely liquid. If an emergency happens, you can sell your shares and have cash in your bank account within 48 hours. However, that liquidity makes you vulnerable to your own emotions. When the market drops violently, the ease of selling makes it easy to panic and destroy your long-term compounding. A house is illiquid. You cannot sell one bedroom to pay a medical bill. Exiting the investment takes months and costs roughly 6% in agent fees. That illiquidity is actually a behavioral benefit. You don't see a ticker showing your house value drop every hour, which physically prevents you from panic selling during a recession. To compensate for these frictions, the tax code favors property owners. The IRS allows you to claim depreciation, a paper loss on the building's value that acts as a tax shield, often protecting your rental income from being taxed at all. Real estate makes up for its high maintenance by offering behavioral protection and tax advantages that are unavailable to standard stock investors. To choose the right path, you can use this matrix to filter your current capital and time. If your net worth is under $50,000, your priority is building a foundation without the risk of debt. The clear choice is the stock market. If you have over $50,000, but you value your free time or suspect you might need cash in the next 5 years, the stock market remains the better tool. If you have a down payment ready, you want to use leverage to build wealth, and you are willing to manage a property business for monthly cash flow, choose real estate. If you are approaching retirement age, the goal shifts from accumulation to preservation. Moving out of physical rentals and into dividend stocks and REITs helps you avoid the labor of property management. You don't have to pick one asset forever. You choose the one that solves the specific financial problems you face right now. Wealthy investors rarely choose just one side of this debate. They systematically use both. Most begin by buying index funds because the compounding engine requires no specialized skill and has the lowest barrier to entry. Once that capital base is large enough, they take portions of those market gains and move them into physical property. This results in a hybrid portfolio. You hold stocks for passive growth and liquidity, alongside real estate for tax-shielded cash flow and leveraged appreciation. Rushing into real estate too early creates dangerous concentration risk, but ignoring it later in life means missing out on significant tax advantages. Start with the low barrier of the stock market today. Build your base and buy the property once your finances are secure enough to handle the risk.
I am Fiana, and you are watching the Roadmap channel. Don't forget to subscribe and like. See you soon.